Welcome back. We are now in section 6.16, and in this segment we will be doing the CMA entry of a corporate balance sheet. We'll take the example of Tata Steel Limited. In the earlier chapter, in chapter 5, we have seen how to enter the P&L, the operating statement in CMA data. So in this section we will see how to enter the balance sheet into the CMA data. Okay. So this is a balance sheet of Tata Steel Limited. If the font is a bit low, please zoom it, or you can access this balance sheet. It's publicly available document. You can go to the website of Tata Steel and download this balance sheet. So this balance sheet is for the year ended 31st March 2012. So let us go ahead and make the entries. So if you just take a quick look through the balance sheet, you can see that most of the entries are direct. No way to place them into the CMA data. So starting with the shareholders funds, you can see the items share capital, reserves and surplus, and then in the non-current liabilities or long-term borrowings, most of the items have schedules attached. If you see the second column has so all these are page numbers. So if you go to that, you'll get a detailed breakup of this. These are the schedules which we'll see in detail. So whenever we make an entry for an item, we need to go into the corresponding schedule and see further breakdown of the individual items. So we'll make the current entries. Okay, for example, an item like inventories. Inventories is made up of lot many items: raw materials, work in progress, finished goods, stores and spares. Okay, so we need to go into the breakup. If you go to the corresponding schedule, you'll find the breakup. Okay, that's what we'll be doing in this segment. So the first item is share capital. Okay, this is 971.41 crores. Before we make the entry in the CMA data, in CMA data we have a line for share capital. But before we place that in that row, let us see what this share capital is made up of. Let's see the breakdown in the schedule. So this is the schedule for 971.41 crores. Seems straightforward, right? So there is this is what you have to say: subscribed and paid up capital. Okay, this 971.41 is the sum of these two items. Okay, one is the ordinary shares and other is the amount paid upon ordinary shares forfeited. So this figure you can directly put it into the CMA data. So this also has the information on the authorized capital. Okay, if ever you want it in a process note, there will be usually a row for entering the authorized capital. You can pick from here. Okay, so all we are interested right now in CMA data is the sheet cap is the paid up capital. So let us put 971.41 crores in the CMA data. So here we are into the CMA data, and you can see that 971.41 crores is placed under the share capital. Okay, where is this available? This is available under the liabilities. Okay, under liabilities we have an item called share capital. Under share capital, please put 971.41 crores. That is highlighted in the yellow cell. Okay, so this is the share capital. Straightforward entry. The next item is reserves and surplus. That is 51649 crores. So this is a huge amount, 51,000 crores. So what is this breakup? In CMA data, if you look at it, actually you got a couple of breakdowns for this reserves and surplus. Most common breakdown will be one is called the general reserve. Okay, then you have a capital reserve. Sometimes this is there, sometimes not there. Then you have surplus in P&L account, and rest of us clubbed under other reserves. Okay, so if this breakup is not furnished, you can put this figure directly in reserves and surplus, right? But some banks insist on the breakdown. Okay, there's something called revaluation reserve also. Like whichever item you want, you can create additional rows in the CMA. There's no fixed format, right? There used to be a fixed format provided by RBI decades back. That was when the credit monitoring was in place. Okay, now banks do modify CMA a bit, though by and large it is the same. But if you need the flexibility, if you want to insert additional rows, you can do that. So let us see what is the breakdown available in our CMA format for the item reserves and surplus. So as you can see, these are the items we got under the breakup of the reserves and surplus. Okay, so you have general reserve, revaluation reserve, surplus in P&L account and other reserves. So what we'll do is we'll go to the Tata Steel's balance sheet. Under the item of reserves and surplus, see the corresponding schedule. Right, there will be a lot of items. Okay, which will add up to the total reserves and surplus. From that, what we'll do is we'll take general reserve, we'll take revaluation reserve if there is any, we'll take surplus in P&L account, and that balance we will dump it under other reserves. Okay, so this is the 51,649 crores of reserves and surplus. So let us see what are the individual items. So there is a capital reserve, capital redemption reserve, securities premium reserve. This is when the shares are issued at a premium, right, to the face. Say for example, the face value is 10, and when you have issued the share for 100, the 90, the difference 90 is the share premium. Okay, that is put under the, so this 10 goes to the paid up capital and the balance 90 goes to the securities premium account. Okay, so this is a debenture redemption reserve, amalgamation reserve, a lot of reserves. Okay, since a CMA format doesn't have place for all this, what we'll do is we'll take the important reserves and the balance will keep under the other reserves. So what we'll do, let us take the general reserve, right? 9416.7. We don't have any revaluation reserve, so let us take a general reserve, surplus in P&L account, right? And the balance will put it under other reserves. Okay, so 9416.7 goes to general reserve. Okay, 9416 goes to the general reserve. There is no revaluation reserve, so we leave that blank. Surplus in P&L account is 21145. So 21145 will put it under the surplus in P&L account. So we have taken general reserve 9416.7. We taken the surplus in P&L account, that is 21,145.04. So if you add it up, you'll get 30,561 crores. So what is the balance? So the total reserves and surplus is this figure, 51,649.95. From this you deduct the sum of these two, general reserve and surplus and P&L account. So you'll get the sum of all the remaining reserves. What is this? So this is 21088. Okay, so this 21088 we put it under the other reserves, right? So the total figure available in the reserves and surplus in the balance sheet we have split into the major components, that is the general reserve, surplus and P&L, and the balance we have dumped it under other reserves. Okay, so that part is completed. The next item is the hybrid perpetual security. Okay, this money received against shareholder is nil. Okay, now the next item is the hybrid perpetual security. We have discussed actually earlier. I think this we discussed towards the end of the chapter on discussion of other current liabilities. Okay, so as the name implies, perpetual means there is no obligation on part of the company for redemption, right? There is no repayment for these securities, right? It's perpetual. So actually the correct way is to club it under equity. Most do that. Actually this is an item which you're not going to encounter very frequently, so don't worry too much about it. This is a big company, Tata Steel, but normally in your regular proposals you will usually not come across this item. But hybrid perpetual security is actually clubbed with equity, actually a debt. You can think of it as a debenture, just like any other source of debt instrument like debenture, but the defining feature here is perpetual, right? So which means there is no obligation for the company redemption, right? So the correct way is to classify is you can put it under share capital, but some banks also treat it as a term liability, right? For safety purpose, let us classify it as a term liability in this example, but doesn't matter. You can also club it with equity. In this example, I'm going to classify it as a term liability. Okay. This other term liabilities also include hybrid perpetual security. So 2275. The figure is 4985 because in future you're going to get some other entries. This is actually this, the summation of all these items. We'll enter the balance items later. The first item is 2275. This is what we entered. This is a hybrid perpetual security. So for this example, I have classified it as a term liability. Okay. The next item is 21353. Right, long-term borrowings. So let us see the schedule. What is the breakup of this 21,000 crores pertaining to long-term borrowings? So this is the 21,000 which you have seen. Okay, so what Tata Steel's balance sheet has done is the total borrowings, right, are classified into secured borrowings and unsecured borrowings. Within this, again, they're classified as long-term and short-term. So what we've seen earlier, this 21,000 is the long-term portion of the borrowings, both secured and unsecured. So what we'll do, we'll take this total, right, 21,000, and we'll see where to place these individual items. Okay. So term loans from financial institutions, you are well aware. This is directly we can put it under term loans from banks. So in CMA data, we have a entry for term loans from banks and financial institutions. This we can keep because it is a term liability. Okay, yes, because company has provided the classification between long term and short term. Right. Usually we take this classification as it is, unless there is a compelling reason why we should not take it. Okay. So if some reason company is treating a short term liability as a long term liability, then we can, and that seriously improves the current ratio, then we can go with our version. For the moment, let us take the classification provided by the company as it is. So this we'll break up this 21,000 crores and see where each item goes. First item goes under term loans in the banks and financial institutions. This is bonds and debentures. So under bonds and debentures, the company has got various types, okay, non-convertible and all this stuff. So anyway, we're going to put this under debentures. In CMA, we have a separate entry for debentures under term liability. So these two goes there, okay. So the non-convertible debentures and the 4.5% foreign currency convertible bonds both go under debentures. Then there are term loans from banks and financial institutions. Now these two are different from this, okay. This is unsecured, this is secured, and this is unsecured. For the purpose of classification of CMA, we can club it under term liabilities from banks and financial institutions, though there is difference in the security, okay. But for the purpose of CMA, the classification is not that much important, the difference in security. In balance sheet, they are shown, that is important because we need to know which are secured loans and which are unsecured loans. But for the purpose of CMA, both are term liabilities. So let us group these two items also under term loans from banks and financial institutions. And then there's a small item, deferred payment liability. This we can, because it's a small item, we can place it under other term liabilities. So let us go ahead and do the classification. So what we'll do is, we'll take this item and this item and place it on the term loans from banks and financial institutions, okay. So 1915.47 and 8473.72. Let us place both these items under term loans from banks and financial institutions. So here we are. This includes these two, 1915 and 8473. So that I have clubbed under term loans from banks and financial institutions. So this is gone and this is gone, okay. So these two items are bonds, debentures, okay. So these two I'm going to put under debentures, 7,300 and 2,700. So 7,000, this is 7,300 and 2,700. So that I have dumped under debentures. Now please note that we have discussed this earlier. There will be a portion of debentures and term loans from banks, right? Term loans from banks or debentures, okay. Some portion will be falling due within the next 1 year, and some portion will be beyond 1 year, okay. So say for example, a loan of 100 lakhs is stipulated to be repaid in say 28 quarterly installments, that is 7 years. So within the next 1 year, 4 installments are due, 4 quarterly installments, isn't it? Next year 1 year, 4 quarters are due, and 24 quarterly installments are due beyond 1 year, naturally, right? Now these 4 installments will be treated as current liabilities because they are maturing within the next 1 year, and this will be treated as term liability. This we already discussed, but for this example I'm not considering the breakup. Very simple reason being that this company has got a lot of debentures, lot of term loans, and each one's got a very specific repayment period, and all the information might not be available to us, right? But as a banker, you'll be having access to that information, right? If you have the access to the information, please calculate for each loan and each debenture what is the portion that is falling due within the next 1 year and what is the portion that is due beyond 1 year, and accordingly it will classify as a term liability and current liability. For this example, I'm treating everything as term liability, though some portion is actually a current liability. What this does to the current ratio in this example, it improves the current ratio because we're treating everything as a term liability. Had we taken some portion and classified as a current liability, current ratio will drop, right? But current ratio anyway for this company is too low. We'll see shortly. I think it is around 0.7 or something. If we do that, it will fall even further. We'll get to that later. But for the moment, I'm treating everything as a term liability. Okay. So we have made entries for term loans from these two, term loans from banks and debentures. Gone. So what are we left with? Financial institutions and deferred payment liability. Actually, you can club this 849 also with term loans from banks and financial institutions, but I have not treated that. I'm treating it as a other term liability. Actually, when you executives, when you put up the proposal to your executives process note, they actually like to see the difference between term loans from banks and term loans from financial institutions because the securities are different, the charges are different, right? The treatment is different. So it's good if you classify it separately. For this example, I have therefore taken only taken this item under term loans from banks. Okay, this I'm going to place on the other term liabilities. Okay, so 849 plus 3.6. This I'm going to treat it under, then 3.8. I'm going to placed under other term liabilities, 849 and 3.6. So this includes 849 and 3.8. 2275 is that perpetual hybrid perpetual security. So this completes the long term portion of borrowings. This 21,000 is comprised of these 5 items. Okay, 2 items from the term loans from banks. Okay, 2 debentures, and this item is other loans from other financial institutions. So total 6 items we have placed it in the relevant rows of the CMA data. So we can move to the next item. The next item is deferred tax liability, that is 970 crores. Deferred tax liability we can directly put it on. This is an actual advanced concept. This we discussed in a separate section. I've discussed what is the concept behind deferred tax liability. I also mentioned that it's an advanced accounting topic, so if you're not comfortable, doesn't matter. We're going to treat it as a term liability. So I'm going to place this entire amount, 970.51 crores, into term liability. Okay, but if you're interested, please go back to the section on deferred tax liability to understand what it is. Okay, so this actually is netting, I think, netting. So there will be deferred tax liability, and there'll be a deferred tax liability and the deferred tax asset. So this netting figure is placed here, 970.51 crores. So this I'm going to place under term liabilities. 970.51 crores goes under deferred tax liability. It's a term liability. Okay. Then the next item is 216.05 crores. That is other long-term liabilities. So what are these other long-term liabilities? We have to see the schedule. So let us go to the schedule and see what is this 216 crores. So what is this 216 crores? It is a creditors for capital suppliers. So this we discussed. This we're going to place it under term liabilities, right? Some banks treat it as a current liability, so you need to get the clarification from your loan policy guideline. But we are treating here it as a term liability. Right? It's also correct. Mostly it's the correct classification, right? So let us put this item, and there's also other small item 5.94. This we can put it under other term liabilities. So this goes into creditors for capital goods. This goes into other term liabilities. 210 and 5.94. So 210 and 5.94. This includes 5.94. So this 210 is the creditors for capital goods, and we are classifying as a term liability. The next item is 1851 crores. What is this? Long-term provisions. So let us see what are these provisions. So this is the long-term provisions. So again, the company has provided bifurcation between long-term and short-term. The total provisions are bifurcated into long-term and short-term. This way, at the moment we are interested in long-term provisions. So what are these provisions? Provisions for employee benefits and provisions for employee separation. So where do we put this? Actually, provisions more under current liabilities we have an item called other provisions. Right? There is a separate class entry for provision for taxation, and all the other entries will put it under other provisions under current liabilities. But here the company has provided a distinction between long term and short term. So this we can put it under other term liabilities, right? Specifically because the company has given this information. Had this information not been given, and just only provisions is given as 1851 crores, we'll put it the current liabilities and provisions. So 1851 goes into other term liabilities. So 1851 goes here under other term liabilities. Then 65.62 crores, this is short term borrowings. Let us see what is the 65 crores. So the 65 crores is the short term borrowings. Only one item, other loans. So let us put it under other current liabilities. Other current liabilities. Okay. So because this is not long term, let us not put it under term liabilities. Let us put it under current liabilities. And since no specifically item is not defined, we can put it under other current liabilities, right? So let us put 65 crores under other current liabilities. So that 65 crores we have put it under other current liabilities. There will be more items that will be added under other current liabilities. So first item is 65 crores under other current liabilities pertaining to short-term borrowings, other loans. Next item is 5973 crores. What is 5973 crores? This is trade payables. So that means payables are creditors, okay? But let us see the bifurcation. So this is the bifurcation 5973. This includes creditors for supplies and creditors for accrued wages and salaries. So if you recall, we have discussed this. Creditors we're going to classify under three items. One is the regular trade creditors. These are sundry creditors. These are your raw material and other material, stores and space and other supplies. This is the suppliers, regular suppliers, okay? And this forms the major portion of the creditors. Then there will be creditors for expenses, right? These are also payments pending the company has to make, right? Short-term liabilities, but they are not related to the main trade, okay? Not the raw material, okay? And then the creditors for capital goods. This we already classified in this example. These are payments pending to the machinery suppliers, capital goods suppliers, okay? So this example has these two. So here this 5973 crores is broken down to 5111 crores for this supplies, trade suppliers, and accrued wages and salaries is the creditors for expenses. Okay, so let us do the classification. So this we are going to put under sundry creditors, trade creditors. 860 we are going to put under creditors for expenses. 5111 I have placed under sundry creditors trade, and 862 under creditors for wages and salaries. Right? Actually, there is no entry for creditors and wages and salary. I have created a new row. This you can do. Or if there are any other blank rows, right? Any items which your present balance sheet doesn't have entry for, you can delete that and put it there. Okay. So creditors for wages and salaries, you created a row. Okay. So these two are done. Next item is 8798 crores. Other current liabilities. Whenever you have items like other current liabilities or other current assets, make it a point to go to the schedule and see the breakup. Don't just put it under other current assets, because in CMA you have an entry for other current assets, other current liabilities. Those entries have to be made where you don't know the items, exact nature of the items. It's like a miscellaneous entry. But if you know the breakup, you have to go to the corresponding schedule, see the breakup, make the relevant entries, and then anything left over, only then you have to come into other current liabilities or other current assets. So even though this item pertains to other current liabilities, don't directly put it under other current liabilities. Let us go to the schedule, see whether there are any major items which we can put elsewhere, and then if we are unable to put it, then we'll come back to the miscellaneous entry of other current liabilities. So let us go to the schedule. So this is the schedule 8798. This is other current liabilities. So what are these entries? Current maturity of long-term borrowings, interest accrued but not due, unpaid dividends, application money, unpaid mature deposits, advance from customers, and creditors for other liabilities. So what is a major item? This is a major item. This is current maturities of long-term borrowings. This is something which we were discussing earlier, right? So in term loans and other debentures, other debt instruments, there will be a portion that will be falling due within the next 1 year, that you have to classify as a current liability. So here the company has provided that current maturities of long-term borrowing. So this I'm going to classify under. We have a relevant head for it under the CMA data. So this item goes there. Okay, 4753.43. So 4753.43 goes under deposits, debentures, installments of term loan that are due within the 1 year, and it's a current liability. Okay, so this entry we have made. Then this is done. 683.4. This is interest accrued but not due. This is a concept which I have discussed. The interest is accrued but not due. If you recall, we had an example on interest on a bank fixed deposit, where the bank makes the interest payments at the quarter ends of March, June, September, and December. Whereas, say for example, this is 30th April. The interest for this period, April 1st to April 30, the interest is accrued, but the payment is not yet due, because bank will be making the payment only for this only at the end of the month of June. The payment for this will be coming in at the end of June for the 3 months put together, April, May, and June. So this 1 month interest, if you're speaking of the balance sheet as on 30th April, right? As on 30th April, this 1 month interest will be accrued, but it's not due. The payment is not yet due, but it is accrued. Okay. So where do we place that? We put it on the current liability. If there is an entry, separate entry, we can put it. Let us see. Or else we put it under other current liabilities. So that item is 683. So that amount is 683 crores. So that 683 crores here, right? And put it under other current liabilities. Okay. So these two are done. Next, unpaid dividend of 45.81. Unpaid dividend. Okay. So all items related to dividend, I will put it under a separate heading. In CMA, we have an entry for dividend. Dividend payable, I'm going to club it there. Okay. So there is a separate entry under CMA for dividend payable. This is not dividend payable, this is unpaid dividend. But since we are going to treat it, because this is also current liability and relates to dividend, I'm going to club it under dividend payable. So this 45.81 I'm going to place it under dividend payable item under the current liabilities. So 45.81 goes under dividend payable. This item will come to it shortly. This is actually the dividend payable amount. We have clubbed the unpaid dividend also under this head, because it relates to dividend and also due within the next 1 year. It's a current liability. Next, this is small amounts. Okay, 17 lakhs and 33 lakhs. Application money received due for refund and unpaid mature deposits. This you can dump it and club it under other current liabilities. Put together is 50 lakhs. Okay, 17 and 33. So other current liabilities. So 17 lakhs, 33 lakhs under other current liabilities. Then there is an item called advance receipt from customers. This is 333 crores. This is a major item, and in CMA we will be having a separate row for advance receipt from customers. So let us put it there. So 333 we are putting under advance receipt from customers. Okay, advance receipt from customers is a current liability, because you have to provide the goods or service for the customers usually within the next 1 year. So it's a current liability. Then there is a 2981. This is a creditors for other liabilities. This we can put it under the other current liabilities, right? Because we don't have any additional information. This we are going to classify under the current liabilities. 2981 crores. So this includes 2981 crores. This is the other current liabilities. Next item, that's the last item under liabilities, is short-term provisions, 2066 crores. Let's see the breakup. So this is the breakup. 2066 is the provisions, short-term provisions. What are the items? This is the item which we have a separate row. This will usually keep a separate track of provision for taxation. So this item 651 crores, I'm going to put it under provision for taxation under CMA. There is also an item proposed dividend. This we have a separate row. We just was that's the dividend payable. So this we're going to put there. So these two items I'll put in the relevant rows. So provision for taxation 651 goes there. So 651 goes under provision for taxation, and 1165 goes under dividend payable. So 1165, this includes that earlier that unpaid dividend, okay, and the now the proposed dividend put together and put it under dividend payable. And after making those two entries, we're left with some other item that I'm going to put under other current liabilities. This is the short-term provisions, right? So I'm going to put under other current liabilities and provisions. What are the items? 76, 167 and 4. 76, 167 and 4. Here it is, okay? 76, 167 and 4. So that I have put it under other current liabilities and provisions. And this is complete. So all items related to liabilities, right? Equity liabilities, long-term liabilities, short-term liabilities, everything is completed. So this completes the liabilities portion, right? We can then move on to the asset side. So these are the assets. So let us go ahead and do the classification. The first item is fixed assets. So tangible assets, capital work in progress, and intangible assets. So the first item is 11,142 crores, another tangible assets. So let us go to the schedule for fixed assets, where they will be having the detailed breakup. We'll have entries for gross block, accumulated depreciation, and net block. This figure 11,142 is nothing but the net block, right? But CMA requires both gross block and accumulated depreciation. So let us go and fetch the corresponding figures for this 11,142 crores. Okay, so that 11,142 is this figure. This is the net block. Okay, so let us try to find this is the net block as in 31st March. Okay, so let us see what is the gross block. This is the gross block, right? 22857 is the gross block. So we'll take this figure, and from this we'll subtract the accumulated depreciation and impairment. Impairment is an advanced topic. Leave it. Okay, so you're aware of accumulated depreciation, right? So we'll take this figure 11,715. That difference will give us the net block. Okay, so let us put these two entries in the same data: gross block and accumulated depreciation. 22857. So this includes 2258857. This is the gross block, and also let us make the entry for accumulated depreciation 11715. So this includes 11715. So this is accumulated depreciation. So relating to the tangible part, we have made the entries for gross block and accumulated depreciation. Okay, these are the two entries. Okay, now let us go to the intangible assets. Don't worry, intangible assets is a advanced topic. To put it simply, they also be having the same entries: gross block and accumulated depreciation. So this entry we have completed related to tangible assets. So intangible assets also we are having 223.9 crores. Let us see what is the breakup of that 223.9 crores. So 223.9 is this figures. That's the intangible assets. So here also we'll have the gross block and the accumulated amortization. We call it amortization under. We don't use the term depreciation. For fixed assets we use depreciation. For intangible assets we use the term amortization. Don't worry too much about the terminology. All we're interested for the moment is the gross block and the accumulated amortization. So let us take the gross block as of 31st March 2012. This is the gross block 627, and what is the accumulated amortization? 404, 627 and 404. So this includes 627, right? And this includes 404. Okay, so we have made the entries for the fixed assets. Gross block less accumulated depreciation gives the net block. There is also an item for related to capital work in progress. Here in this CMA formula we don't have it, so I'm going to club it under gross block. There will not be any depreciation for capital work in progress because it's still work under construction. Work is under progress. The asset is not yet completed, so there won't be any depreciation charged to the capital work in progress. So it doesn't. So there's no harm in clubbing under gross block. But banks usually have their internal process notes usually have a separate row for capital work in progress. So it will be gross block, accumulated depreciation, and also capital work in progress. They'll be having 3 rows. Here we don't have that, so I'm putting under gross block. So what is that amount? So that item is 16,058 crores. So let us club it under gross block 16,058. So this includes 16,058 capital work in progress. Okay, so we have completed the fixed assets this portion. So we'll move on to the non-current investments. So non-current investments is 49,000 crores. It's a huge amount. Let us see what is the breakup. 49,000 crores. So this is the schedule for non-current assets. Actually this will be running in 4 to 5 pages. Okay, there's a lot of breakup. So if you see non-current investments, you have trade investments, investments in equity instruments, investment subsidiaries, unquoted, quoted. So there are a lot of companies into which the investments have gone into. So many items, so many companies. Then there is investment in joint ventures, right? Investment in associate companies, investment in others, quoted and unquoted, investment in subsidiary companies, investment preference shares, quoted and unquoted, investment in bonds. So that the 49,000 crores which you have seen, okay, is made up of so many items. So for us CMA purpose, we're not interested in all that. So what we'll do is we'll break this item into investment in group companies and subsidiaries. That is very important for us, because when you calculate TNW, I told you we have to, if you're really interested in calculating TNW, you have to calculate what is known as adjusted TNW. So we'll from the TNW we'll deduct the investment in associate companies. The reason for this we have discussed earlier. Okay, so this is an item which this is very important from CMA classification, right? So from this total figure we'll take out this group companies. So any item related to group companies we're going to put it here, right? And others let us put under other investments. So let us go ahead and see this. Now some of the items are quoted, right? If it's a quoted investment, we can put it under current assets, right? So quoted investments, CMA, the correct classification of CMA is current assets, because they can be liquidated very fast. Say for example, investment in mutual funds, right? It can be liquidated very quickly, right? So those sort of items we can, because it's a quoted investment. Unquoted investments you're going to put it under non-current asset. Okay, so to make it clear, so what I'm saying is, look whether it is an investment in subsidiary or group company, yes or no. Okay, so if it is an investment in subsidiary company, associate company, joint venture, put it under non-current asset straight away, right? If it is not investment in subsidiary or group company, look at it whether it is a quoted or a unquoted. If it is quoted, put it under current assets. If it is non-quoted, put it under non-current asset. We can follow this. For this also we can do this classification. The investment subsidiary, if it is quoted, we can classify it as a current and non-current. But to be on safe side, this is always suggested. Any investment group companies, put it under non-current asset. And then if the ratios really, current ratios and other ratios really do fall drastically, then we can consider based on a case-to-case basis and seeing the justification whether to move that portion into current asset. Okay, but broadly you can follow this classification. So for every item under this schedule, this 49,000 crores, what we are going to do, we are going to see whether it's a investment in a group company or subsidiary company or joint venture. If it is yes, we are going to straight away put it under non-current asset. If it is not, we are going to see whether it's a quoted or an unquoted. If it is quoted, let us put it under current asset. If not, non-current asset. So that classification which were discussed shortly, all investments in subsidiary group companies, whether quoted or unquoted, into non-current asset, I'm going to relax for this specific example, because this big company and already the current ratio is on the lower side. So only for that reason I'm going to ignore this rule. But for your regular proposals you can do that. Okay, for this example, only for this specific example I'm going to relax that a bit. So if it is a quoted investment, I'm going to classify it under current asset. Okay, so this quoted investment 361 I'm going to put under current asset, and unquoted I'm going to put under non-current asset. Okay, so 361 goes into current asset. So 361 includes, this is a government and other trustee securities, includes quoted investment. Okay, this is a current asset, comes after cash and bank balance. So all the investments, the short term, the government trustee securities, fixed deposits to banks, all these are current assets. Okay, so that item 36146 I have put it in current asset. An unquoted portion 46913 I'm putting on the non-current asset, investment in subsidiary companies, 46913. So this 46913 I'm putting under other non-current assets, investments in subsidiary group companies. In CMA we'll be having this entry, definitely we'll be having this entry, right? We can put this here. Again, only for this particular example, I usually do not recommend this. If it is an investment in subsidiary company, either quoted or unquoted, it is best to place it under non-current assets. But for this example, I'm not doing that. I'm putting the quoted investments under current assets, because the current ratio for this company is already on the lower side. Okay, and this is a major company, and we are going to discuss what current ratio actually means when it comes to ratio analysis. Low current ratio for big companies is not a problem. It's actually due to the efficiency on the side of creditors. That will come to it later. So based on that logic, I'm putting it under the quoted investments under, even though it's a quoted investments in group companies, I'm classifying as a current asset. Then investment in joint ventures unquoted. So naturally this will go into investment in subsidiary group companies, non-current asset, because it's unquoted. Investment in joint ventures 798. So this includes 798. This is non-current asset, investment in group companies. So investment in associate companies, quoted and non-quoted. Quoted 11.58. Let us put it under current assets 1158. So this is includes 11.58 current asset. Okay, and the 137.8, that is the unquoted investment in associate companies, I'm going to put under non-current asset 137.8. This includes 137.8. Okay, non-current asset, investment in group companies, subsidiary, affiliates, associate companies. Then again, investment in others, quoted and unquoted. Quoted portion, let us put another current assets, 291. Here it is. This includes 291 under current assets, and 290.76 is the unquoted investments. This will put another non-current assets. Actually this 290.78, if you ask me, it should come here. Others, say this is not investment in group companies. Okay, but classification both are non-current assets, so please make the correction. Okay, so this I have put it under group companies. Actually, it's not group company, right? But it's a non-current asset, so the classification will not matter here. Okay, both are non-current assets. Investment in others, quoted and unquoted. So 291.93 and 290.76. So 291 goes here current asset, and 290 goes here non-current. Again, investment subsidiary, unquoted and quoted. Unquoted, so 270 goes under non-current investments, non-current assets, and 273. So this includes the 273. Okay, so this is the investment group companies, this is subsidiary companies, unquoted, and that's it. So that completes all the investments. Okay, so that for 49,078, this figure we have broken down into various items, whether it's a quoted or unquoted. Right? If it is quoted, we have put in the current asset. If it is unquoted, we have put in a non-current asset. Okay. So the most important item under this non-current asset is the investment in group companies. This is very important. Right? Investment in group companies, associate companies, subsidiaries, joint ventures. Right? That is very important. Calculating that adjusted TNW. Okay. Because if a company has a lot of, say for example, the net worth of a company is 100 crores. Right? But let us assume that out of this 99 crores is invested in a group company. So what is this company for? This is basically a front company or a company developed with a view to hide the identity of this original company, right? So the investment in this company is only 1 crore. You don't want those sort of companies, okay? Not that every company is doing like that, but if a major portion of the investment in this company is elsewhere, is not in this business, you have to calculate that adjusted net worth, right? What is the investment of the company actually in this company, in this project, okay? So this is very important from a CMA classification. The next item is 404.9 crores. That is the foreign currency monetary item translation difference account. Complex term, but it's a non-current asset. Okay. This relates to foreign currency transactions. So and it's a non-current asset. So let us classify it under other. There's no entry specifically for this row because these are rare items. So let us put it under other non-current assets. 404 crores. So other non-current assets. This includes 404.9 crores. Okay. Then 6,415 crores. What is this? Long-term loans and advances. So let us see what is the breakup is. 6,415 crores. So this is the loans and advances. Okay. So it's again bifurcated into long-term and short-term, and the long-term portion is 6,415 crores. So this portion, let us see what are all the items under this long-term portion. Okay. So here we have capital advances. Okay. So what are these capital advances? It's a non-current asset. Okay. And you can treat it as an advance for capital goods suppliers. Then security deposits, this goes under deposits. There is a separate entry for deposits on the CMA, so you can take it there. This is advance with public bodies. This is also similar to deposit. Right? What are public bodies? Say municipal and other government agencies. These are deposits, equivalent to deposits. Okay, this is a non-current asset. Don't expect money to be coming back from the next 1 year. So don't expect that. So put it under non-current asset. Then is loans and advances related parties. This we can put it under, club it under loans and advances investment in sister companies, associate companies. Okay. Advance payment against tax. There is an item. You can club it. You can actually do it the netting. Under liabilities you have provision for taxation. Assets you have advance tax. You can do the netting, or you can put it here. No problem. Then there is other loans and advances. No classification. No further classification. So we can put it under. So this we can put under other liabilities. Okay. So let us start with this capital advances. 2448. We're going to put it under capital good, advance to capital good supplies. 2448. So 2448. We put it under advance to supplies of capital goods. So advance to capital goods suppliers is a non-current asset. Okay. So in CMA we will be having a separate entry for advance to capital goods suppliers. So this 2448 I have placed under non-current asset, advance to suppliers of capital goods. So this we have put. So this 83.72 is a security deposit. So usually the doubtful portion will actually be removed. Okay. So less provision for bad and doubtful debts. Okay. So that portion will be removed. So you don't worry about this. Take the final figure. 83.72 crores is security deposit, and also advance with public bodies. This also we can club it under deposit. So 83.72 plus 313.2, 83 and 313. So this is 83 plus 313 that we put under security deposits, tenant deposits, and all these deposits we can put it under single head and deposits here in non-current asset. So this includes 1907. So this is the investment in group companies. It's not actually an investment. This is loans in advance. So there's a subtle difference between investment in loans in advance. Loans in advance is something you'll get back. Investment could be you can get it back or not. It could be a long-term investment. Okay, loans in advance is usually a short-term. This could be investment in the capital, right? For all that we know, this could be investment in the share capital of the other company. So that's not so easy to get back. But anyway, both this we are going to classify in the non-current assets. Even though this is a short-term advance recoverable, usually any related transactions with the group companies you're going to treat as non-current asset. So this I have put it under non-current asset. So that is gone. Then advance against tax, advance payment against tax. So 173. Let us put it under advance payment for tax. You can put it under current asset. Usually we'll put it under current asset, but because specifically the company has given it under non-current asset, I'm going to put it under non-current asset 173.05. So this includes 173.05. So I put it under other non-current asset, right? If it is not given under the non-current asset, so in this example, this was specifically given under non-current asset, right? Loans in advance under long term it is given. So that's why I put it under non-current asset. But if this information is not given, usually advance payment for tax, you're going to put it under current asset, right? Other current asset will put under advanced tax, or we'll do the netting with other provision for tax under current liabilities. Okay, so most of these items are completed. So what are we left with? Other loans and advances, right? So 1490, no further classification, so let us put it under other current asset. But this is long term portion, so let us put in other non-current asset. Okay, 1490. So this is 1490 under other non-current assets. Okay, other non-current asset. So the 6415.8 is over long-term liabilities. There's other small other non-current assets, some 2 crores that also we can put under non-current asset, other non-current assets. Okay, so let's do that. So the other non-current assets include the 276. Okay, so this is a small amount. So that completes the long-term portion, non-current assets. So the next item is the current assets. Okay, starting with current investments 1204. So let us see what is this 1204. So 1204 is the investment in mutual funds. These are unquoted. This we can investment mutual funds you usually can put in the current assets, but here is specifically mentioned unquoted. So let us put it under non-current assets 1204. So this 1204 I am putting under others. It's a non-current asset, right? Because this is an unquoted investment in mutual funds. So the next item is inventories, major portion 4800 crores. So let us see the breakup for this. This is the breakup 4800. We have raw materials, work in progress, finished goods, stock in trade, and stores and space. So all these items we can put it in directly under the relevant head in the CMA data. So let us do that. Raw material is 2200 crores, 2241. So this includes 2241. Okay. This is less than 2241 because there is a minus entry that we are going to see shortly. Right. So the raw material 2241 I put it under the current assets under raw material. If you have the information on important breakup that the bifurcation you can do. Okay. I have put it entirely under indigenous. So raw material is over. Work in progress is 53 crores. Let us put it. So work in progress 53 crores. Stock in progress or work in progress. Okay. Finished and semi-finished goods 1639. So this includes 1639. Okay. This is the finished goods. And then there is 76 lakhs stock in trade. Right. So let us have a separate row for this. Stock in trade 76 lakhs. So this includes the 76 lakhs. The stock in trade, goods in transit. Okay. And then stores and space is 922 crores. So this includes 922 crores on the consumable space. Okay. Now included above goods in transit. Again, this is not something you're going to see very regularly for this. So in this balance sheet that item is there. So this includes, so this 562 is pertaining to goods in transit, but it's not a separate figure. This is included in the above figure. So what we'll do? See, this raw material is 2241. Okay, so this 2241 includes goods in transit of raw material 462. So what we have to do under the regular raw materials, whatever is this 2241 minus 462, that we put under the regular raw material under the current asset. Okay, 462. Let us put it under goods in transit. So for under goods in transit, we are going to put 56214. Okay, so let us put 56214 under goods in transit, 56214 under goods in transit. And let us subtract from each item that corresponding portion. Let us subtract 462.4 from raw material, 1.55 from finished goods, and 98.98 from stores and spares. Right? For example, 462 we had deducted from raw materials. So 462 we had deducted from raw materials. Again, don't worry too much about it. You're not going to do this regularly. right? Straight away, whenever you see raw material, work in progress, finished goods in the balance sheet, put it under current assets under this respective heads. This is a small adjustment here for this company specific case. You're not going to need that often. Next item is 904 crores. That is the trade receivables. That is the debtors. Let us see the breakup. 904 crores. 904 crores. So this is the 904 crores. Okay. So their data is more than 6 months and data is less than 6 months. So usually it is a practice in CMA classification. This data is more than 6 months is classified under non-current asset. Because it's pending for a long time, 6 months is a long time actually. Because in the normal credit period usually you say 30 or 45 days or 60 days at the max. So these data have not paid even after 6 months. So that's a long pending. And what it means is there is little scope for recovering. I mean, you might ultimately recover it, but the chances are low. So let us, to be on safe side, let us classify it as a non-current asset, because classifying it as a current asset will actually boost up current ratio. So usually the practice is classify debtors more than 6 months as non-current asset. This is the regular debtors, we put it under current asset. Okay, and provision for that doubtful debts you're going to deduct under current assets. Debtors, what are you going to put? 880.91 less provision 11.34. So that comes around 870, 868 something, right? 868. So this we put here. Okay. So that receivables. These are regular debtors. These are the regular debtors, right? These are put under receivables. These are less than 6 months. And debtors more than 6 months we are going to classify as a non-current asset. 34.51 crores. So 34.51 crores here in the non-current asset. Okay. These are debtors more than 6 months. Then 3946 cash and bank balance. Let us see, usually this entire portion goes into cash and bank balance, but let us see, are there any special entries? 3945 crores. So 3946 crores, what is cash in hand, checks, balance in the banks. So no special items. So entire amount I'm going to classify as a current asset, cash and bank balance, 3946 crores. So entire 3946.99 crores classified under current asset, cash and bank balance. Then 1828 crores, then 1828. This is the short-term loans and advances. Let us see the breakup. What is this 1828 crores? So this is the 1828 crores. Earlier we have classified this portion, long-term loans and advances. So short-term loans and advances, 1828 crores. So what are these items? Advance with public bodies, advance related parties, other loans and advances. So out of this 589.06, let us put it under other current assets. 589.06. Here it is. Other current assets 589.06 crores. Then this portion, loans and advances, 77.76. This is the loans and advances to related parties. Usually because it's given under short term advances, we can put in other current assets, but any investment or loans and advances to related parties, associates, subsidiaries is safe to put it under non-current assets. So I'm going to put it under non-current assets, 77.76. So 77.76 I'm putting under investment in subsidiary group companies. Then we are left with 1161 crores. That is other loans and advances, short term. So this you can put it under advances recoverable. It usually appears under the name of advances recoverable in cash or kind, or simply advances recoverable. So 1161 crores. 1161 crores I put it under advances recoverable under current assets. Then 12218 is other current assets. Straight away we could put it under other current assets because we don't have the classification. 12218. So 12218, this includes 12218. Okay, so this I put it under other current assets. So all the items are entered both on the liability sides and the asset sides. Now if you go and see the balance sheet, the CMA which you entered, we'll see that the liabilities, total liabilities will be equal to the total assets. If you made the current entries, as long as you made the current entries, the final step should be checking the total of the liabilities and total of the asset. They should be equal. Then it means the balance sheet has tallied. Right? This balance sheet is anyway tallied. This is provided by company, but the numbers which you entered in the CMA data, that balance sheet is tallied or not. You have to check the total of the assets and liabilities. Let's do that. So the total of the assets, okay, is 96,191 crores. Let us see the total liabilities. That will also be equal to 96,191 crores. See here, this is also 96,191 crores total liabilities. So we have made the correct entries. Total liabilities is equal to total assets. So we have made the balance sheet for the Tata Steel Limited. Here are some notes which we can follow. This is available to you in the presentation. There's some notes. This I have not shown in this video. I have just made the entries. If you want, you can go to this presentation later. There might be some differences. This is done at a later date, so some classification might be here and there, but you please follow the video. Anyway, finally the balance sheet should tally. Okay, so various items we have placed, it's put in the video. If there is any discrepancies, you just need to make that adjustment. So one final point I want to discuss here is, do we need to really prepare the CMA? Do bankers need to prepare the CMA? Because CMA data is prepared by the company and submitted by the company to the banks, right? So as a bank, as a credit officer, you will be receiving the CMA data. What have we entered till now? In chapter 5 we have entered the P&L account, the CMA data. Chapter 6 we have made the balance sheet. So these entries are already provided by the company. The company will be making the CMA data and submitting to you. So should you as a banker prepare this again, right? Because this is time consuming. You have to do not for 1 year but 3 years. The answer is yes. You have to do it. In case of urgency where time is real constraint, you can take that CMA data provided by the company, and this is something which most bankers do because it is time consuming. But it's always proper on part of a credit appraisal officer to do the CMA classification himself. The two reasons for it: one, you'll get in the classification right. Don't ever rely on the classification provided by the company. Never rely on the classification provided by the company. You'll be in serious trouble. Companies classify some non-current assets into current assets if the current ratio is less than the norm. They'll be doing all sort of things, and if you go by the classification and finally something bad happens to the account, you'll be held responsible. So always do your classification by yourself. Do the classification by yourself. Incorrect classification can lead to incorrect ratios and incorrect decisions taken by the sanctioning authorities based on that. Okay, so you'll get the classification correctly. Secondly, if there are any intricate items, so if somebody asks you why this current ratio is less, then because you've done the same classification, you'll be in a better position to answer that. So never take the same data given by the company as it is. Do your own classification, and as you keep doing proposals and you make a lot of entries, you'll be getting very good at it. In fact, if you're doing this for the very first time, balance sheet will not tally. It's usually the case. Somewhere some item you'll miss, but as with practice you will get it in one go, right? All these items which we have done now, we're done it in one single attempt, right? Our balance sheet has tally straight away, because as you keep doing it, you know which item, you'll be knowing which item goes where, right? So that will be clear. Okay, initially you'll be finding trouble to get the balance sheet tallied. You'll be missing some items, you'll be misclassifying some items, the total don't tally. It's okay in the beginning, that's okay. As you keep doing proposals, you'll get every balance sheet right. It is very rare that your balance sheet doesn't tally. For an experienced credit officer, it's very rare. That becomes your second nature because you keep doing a lot of proposals. But the important point, important suggestion from my part: never rely on the CMA data provided by the company. Do your own CMA classification. This is the bread and butter of your career. If you are credit analyst, you can't escape from the CMA data. It's a very important document. It's a document based on which you'll take the credit decisions. So the figures need to be very correct, especially the classification. So do your CMA classification. Even does it take time? It doesn't take a lot of time once you get very good at it. 3 years CMA data. What is CMA data? If you are in 2014, you need CMA for the last 3 years, 2012, 13, 14. 15, 16 CMA, anyway, company will be covering. That you cannot do it, right? Those are projections submitted by the company. So 15, 16 will take as it is for the company. These 3 years you will be doing. How much time it will take? If it's a very, very complex balance sheet, it will take 2 hours. Very complex balance sheet, 3 years, take 2 hours. You have a lot of entries and all. If it's a regular company, proprietorship or partnership or small scale company, limited company, within half an hour you can complete 3 years if you're good at it. Doesn't take a lot of time. It will appear to be taking a lot of time, but once you get good at it, it doesn't matter. You'll straight away get it correctly. So always do the classification by yourself, right? So with this we come to the end of this chapter, right? In the next segment we'll be doing a small exercise, right? See you then.